Buying your first home is such an exciting journey. Imagining life in your own place, exploring the new local cafes, and meeting new friends. The problem is there is so much information out there, and where first home buyers usually go wrong is not in knowing what to do, but rather what to do next. So that's why I've made this short guide to give you a view of the whole process so you know exactly what to expect and when. Most of the people that we speak to are either saving way more than they actually need to, they're confused about the government schemes that are actually available to them, or they have no certainty and clarity around what their borrowing power actually is. So in this video, what I'm going to do is explain to you what happens and when so you know exactly what to expect through the process of buying your first home. Before we get into the numbers, here's 6 steps that pretty much cover the process from start to finish. Number 1 is to understand your plan, your goals, and your financial circumstances at the moment. Number 2 is to actually work out what your borrowing capacity is across a range of different lenders. Number 3 is to understand your deposit. Where's it coming from? Is it cash? Is it coming from a parental guarantee? Or is it coming potentially from the sale of some other asset? In addition to this, we'll also highlight the cost of buying property, including stamp duty, legal fees, and the other hidden costs that a lot of people don't think about. Step number 4 is actually getting you pre-approved with a lender that suits your circumstances. Number 5, once you're pre-approved, you can actually go out there and start shopping for a property. And number 6, once you've found a suitable property, this is the exciting bit. We move you toward your unconditional approval and actually settling on purchasing the place. The problem is that most people start with the search, and that's where things can go wrong. So looking into each of these steps in a bit more detail, with number 1, we talked about understanding your goals, your plans, and your current financial circumstances. What that actually means is asking the question, where do you want to live? How much ideally would you like to purchase for? What would be a comfortable repayment for you? Then we go and formalize this into a short document that collects all of that information, and the team will use that to actually begin processing your loan and working out the next step, which is understanding your borrowing capacity. Working out your borrowing capacity is not just as simple as looking at your income and plugging it into a few lender calculators. We need to consider a whole range of factors: bonuses, overtime, your typical expenses, and any other debts that you might currently have, whether that's a credit card limit, a car loan, or a personal loan. Other things that can really impact your borrowing capacity significantly are things like whether or not you have any dependents and any current interest rate buffers. As a quick example, if someone's earning 100 grand, if they have existing debts and typically have a high monthly spending, they might be able to borrow about 500 grand. On the other hand, someone who's earning the same amount but is disciplined with their saving and has no existing debts or dependents might be able to borrow up to $650,000. That $150,000 gap is purely based on your circumstances, irrespective of the fact that both people had the same income to start with. So the key takeaway here is it's not just how much you earn, it's how you manage your money. One other small thing to consider before we move on to the next stage is that your borrowing capacity today is not locked in. On the negative side, things like interest rate hikes can reduce your borrowing capacity, but on the positive side, small changes like reducing your credit card limit can actually increase your borrowing capacity quite significantly. Next, deposit requirements. And here's where a lot of people go wrong. There's a preconception out there that you need a 20% deposit to buy a property. That is not the case, especially for first home buyers. There are government schemes in place that can actually let you buy with as little as a 5% deposit. The downside here is that you'll have a bigger loan and thus a larger monthly repayment. Aside from the government schemes, another really popular product that people use to get into the market sooner without having a deposit is a parental guarantee. This is essentially where your parents would use an existing property to guarantee your purchase, meaning that you can actually buy with $0 cash down because the bank will lend against the parent's property to cover the deposit and even the costs associated with buying. Beyond that, there are plenty of lenders who have no or low LMI products as well. So even if you don't qualify for a government scheme, there are a ton of options out there available to consumers now. The key takeaway here is to remember that you don't need a 20% deposit anymore. There are plenty of options, and in fact, waiting to save a 20% deposit can actually cost you tens of thousands of dollars, especially if the market is moving upwards quickly. Aside from the home guarantee scheme, which has been incredibly popular and has helped a lot of people get into a property sooner, there are also stamp duty concessions. Now this varies state by state. I'm going to focus on New South Wales, And these stamp duty concessions actually allow you to pay no or reduced amount of stamp duty, which can be a massive saving. And now the last section of stage 3, which is about deposit and costs, is actually looking into what are these costs outside of stamp duty. Other things that you're going to need to think about is the cost of legal fees and conveyancing. There's a couple of $1,000s that you'll need to allocate here. Building and pest inspection reports can add up super quickly. It can cost anywhere from $300 to $500 for every building and pest inspection report that you get. A lot of people attend a lot of different auctions or are interested in many different properties, and you can see that that would quickly add up if you're getting a building and pest on every place that you're interested in. There are strategies to minimize this. For example, if the property that you buy has a cooling off period, some people will opt to do the building and pest inspection report during the cooling off period so that they know that this is more likely a property that we're actually going to end up purchasing. The obvious downside here is that if the building and pest comes back negatively, then you might be walking away from your 0.25% initial deposit. Other factors to think about are bank fees, although in this day and age they're quite minimal compared to especially what they used to be. But it is important to know that different banks have different package fee structures. Some banks charge, for example, $10 a month, whereas other banks charge around $400 a year. So there is a bit of variance there to think about. Other smaller items, for example, is when you're moving towards settlement, there'll be adjustments for council rates and strata fees. So you also need to keep a little bit of money aside for that. We also recommend that you've got a healthy buffer to allow for furniture and any minor renovations that you might need to make when you move into a place, so that you've got enough money put aside to make the place exactly how you want it to be when you move in. As a quick number though, you don't need hundreds of thousands of dollars as a deposit anymore. We're seeing people getting into the market with as little as $40,000, but $70,000 to $90,000 is a little bit of a sweet spot. And that brings us to step number 4, which is getting pre-approved. Now that we've got a clear picture of what it is that you want to do, how much you can borrow, and where your deposit's coming from, we can now look at getting you pre-approved for your new loan. So I'm going to talk about some of the important factors in getting pre-approved. This is by no means everything, but it's just to give you a bit of an understanding of what we're doing during this stage. Essentially, in a nutshell, in this stage, we are picking a lender that we're going to get you pre-approved with. The choice of lender is based on a lot of different things. For example, do you need the home guarantee scheme? How much deposit do you have available to you? What kind of interest rates are being offered, and what sort of product are you interested in? Who do you do your daily banking with at the moment, and how fast you actually need this approval? All of these can impact the lender that we ultimately go with, because as an example, some lenders are much quicker at providing pre-approvals than others. So if there's any urgency, it might mean that there's a bunch of lenders that we have to scrap just to get you pre-approved in time, say for example for an auction, or to be competitive on a property that's already on the market. Something that is super important that a lot of people don't know or don't think about is that the bank that you get pre-approved with doesn't necessarily mean to be the same lender that you actually settle your home loan with. The reason why this is important is because the journey of actually buying your first home can take a really long time. I've had some clients where we've gotten them approved multiple times, and it's been a 2-year journey from start to finish. People can take as long as they need to find the perfect place to make sure that they're going to love the new home. But what it does mean is that your circumstances might change, interest rates might change, and which lender is going to be best suited to you, most importantly, might change over the duration of you looking for your property. At the time when you've actually exchanged on a place and you're ready to start moving towards settlement, if there is a bank that is significantly better for your current circumstances, we can get you reapproved with that lender and settle with them instead of the one that we originally got you approved with. Some of the things that we think about when we're getting you pre-approved beyond what we've already mentioned is, do you want a variable rate or a fixed rate, or do you want a combination of the both by splitting your loan? Is an offset account important to you? Are you going to have significant savings left over once the purchase is done, or do you think that maybe a basic product with just redraw will be enough? Concurrently at this stage, we're also going to be collecting your documents. These are documents to verify your income, your savings, and any liabilities that you currently have. We collect everything up together, we write an application, and we send it off to the bank for approval. Depending on the bank's turnaround times, pre-approvals can take anywhere from a day to 2 weeks to obtain. Once you've got your pre-approval in place, they usually last for about 90 days, and some lenders will allow us to extend them for another 90 days beyond that as well. Okay, step number 5, and things are getting a bit more exciting now. Now that you've got your pre-approval in your pocket, you can go and start searching for a property that you love. This means attending open homes, negotiating, and making offers. offers. Once an offer's been accepted, you'll then exchange on your property and we'll move to make your loan unconditional. This means that we're satisfying all of the lender's requirements in order to get them ready to settle on your home. Some pretty standard requirements will be verifying your income to make sure nothing's changed, getting a valuation done on the property that you purchased to make sure that the market value stacks up with what you've paid and what's on the contract of sale. And lastly, confirming product and rate and all that type of thing. A standard settlement usually takes place 42 days after contracts have exchanged, and that's usually plenty of time for us to organize getting your loan finalized. During this phase, we also work with your conveyancer to make sure that they've got everything that they need to work on your settlement as well. Once your loan has actually been unconditionally approved by a bank, it's at that stage that they'll actually draw up your loan documents and send them out to you. A lot of banks these days will actually allow you to electronically sign your loan documents, which can make the process super quick and easy, especially compared to what it used to be. Once your documents are signed and returned, they get sent back to the bank and the bank verifies them. The bank will check to make sure everything's in order, that the appropriate insurances are available and on your property, and then they'll make the file ready to settle. From here, you'll need to do a few last things with your conveyancer to prepare for settlement, and then you'll be booked in to settle. On the day of settlement, we'll let you know once it's all completed. And then this is where things get really exciting. Once your settlement's gone through and is completed, you'll be able to pick up the keys to your new place. So hopefully this helped. As I said at the start, it's a brief overview of what to expect during the buying process. Obviously, if you've got any questions, you can ask me anytime and we'll be walking through all of these steps with you one at a time, holding your hand the whole way.